Over the last few years, a tidal wave of global capital has flooded the Dubai property market, driving transaction volumes to historic, record-breaking highs. The core mathematical driver behind this migration is straightforward. The United Arab Emirates levies absolutely zero personal income tax and zero capital gains tax. Combine that absolute tax efficiency with world-class aviation, top-tier schools, and hyper-secure communities, and the city has effectively engineered itself as a premier destination for the global elite. We are seeing billionaires, tech founders, and mobile entrepreneurs, like steel tycoon Lakshmi Mittal, actively uprooting their lives and relocating their wealth to the Emirates for tax-efficient estate planning. While the city serves effectively as an offshore vault for the ultra-wealthy, the financial mechanics for the everyday leveraged investor are far more dangerous. Social media algorithms are currently saturated with agents promising guaranteed 10% returns and easy profits on flipping pre-construction apartments. Those viral videos ignore the reality of 5 to 6% mortgage rates. If you are watching this, you are likely feeling paralyzed. You want the upside, but you are terrified of buying at the top of a hype cycle and getting trapped by hidden fees or developer scams. That anxiety is justified. By 2026, an estimated 120,000 new residential units are projected to hit the market. Success in Dubai real estate requires viewing the city as a collection of highly segmented, cyclical financial tools. Surviving here requires blocking out the Instagram noise, doing the brutal math on frictional costs, and aligning your capital with the correct asset class. Let's look at the typical mid-tier investor, targeting affordable apartments in established areas like the Marina, chasing advertised gross rental yields of 6 to 8%. This waterfall chart breaks down the reality of an 8% gross yield for a buyer using a standard 75% mortgage. First, current global interest rates sit around 5 to 6%. That debt servicing immediately carves out 2% of your yield. Next, you have to pay Dubai's notoriously high annual service charges for building maintenance, which frequently consume 5 to 15% of your total rental income. Finally, a responsible landlord must budget for vacancy. When you subtract that buffer, your advertised 8% shrinks to a sobering net yield of roughly 2 to 4%. In many cases, the cash flow is actually negative in the first few years. You end up subsidizing the property out of pocket while waiting for capital appreciation. High gross yields are an illusion for leveraged buyers. True profitability here demands strict cost management and a holding timeline measured in years, not months. Dubai's lack of annual property taxes is an immense advantage. Once you own the asset, your wealth compounds without the government skimming the top every year. If you buy in London, you are subjected to heavy stamp duties, ongoing council taxes, and income tax on your rental earnings. Try to buy in Singapore as a foreigner, and the government will penalize you with a punishing 60%. To enter the market, you must pay a mandatory, non-refundable 4% transfer fee to the Dubai Land Department. Add the standard 2% real estate agent commission, and you lose roughly 6% of your capital to frictional costs before you even receive the keys. Because of this 6% entry toll, trying to rapidly flip ready, completed properties is mathematically disastrous. You start deep in the red. To bypass those immediate costs, many investors chase off-plan properties, buying pre-construction units directly from developers for cheaper entry prices and staggered payment plans. The trade-offs are severe. Your capital is completely illiquid, you generate zero rental income, and you face multi-year construction delays. If the market turns and you cannot make the installments, canceling is brutal. Under RERA regulations, you forfeit up to 4% of the total unit value, not just the deposit you put down. Then there is the macro threat. Developers in Dubai operate on a massive scale, continuously breaking ground on sprawling, master-planned communities. When that pipeline of 120,000 units completes, generic apartments in secondary locations will face plummeting rental demand as newer, shinier buildings open right next door. Chasing cheap, off-plan generic properties is a trap that leaves undercapitalized investors highly vulnerable to sudden oversupply shocks and crippling exit penalties. A universally good deal does not exist in this city. Success is entirely dependent on matching your specific capital level with the correct objective. We can map this out on a simple matrix. The vertical axis measures your capital level, from mortgage-dependent to cash-rich.
The horizontal axis measures your objective, from chasing yield to long-term wealth preservation. The wealth preserver sits comfortably in the top right. This is a high net worth buyer paying cash for a $2 million plus property to secure a golden visa and shelter their wealth from taxes. The yield hunter lands in the bottom left. They use mortgages to buy affordable apartments, stress test their numbers against 5% interest rates, and commit to a 5 to 7 year holding period. Then we have the highly leveraged speculator. This buyer relies on 80% mortgages or attempts to flip off-plan contracts with minimal cash reserves. Identifying your exact position on this matrix is the only way to avoid buying the wrong asset class and falling victim to the market's hidden costs. That highly leveraged speculator is structurally incompatible with Dubai. They have no buffer to absorb high service charges, construction delays, or cancellation penalties. For everyone else, the trade-off is clear. You get unparalleled tax freedom, but you pay for it with heavy upfront structural friction and ongoing service charges.
Stop buying real estate for Instagram prestige. Stop letting the fear of missing out drive your capital into the illusion of overnight wealth. Dubai heavily rewards the analytical investor. The winners are those who strictly budget for upfront costs, ruthlessly stress test their yields, and hold their assets for the long term. Treating these assets as strategic, segmented financial tools makes Dubai an unmatched global safe haven for preserving and growing capital.